one of the reasons why I selfishly put this event together, because I'm actually writing a book on crowd finance, and I wanted to assemble all of the thought leaders together so I could take notes. So basically, this is chapter 9. So, no, this is great. I'm really excited. You know, one of the things that we wanted to do with this event was not only show how to structure new offerings to reach the retail investor, but really how to market them. And I think for a long time, you know, Wall Street, the sell side, has become so accustomed to dealing with just the institutional investor. You know, they know how to market to institutional investors. It's easy. You know, you could go, you know, find filings, you know what Fidelity is covering, you know what fund manager covers what analyst covers what. But when it comes really down to the retail investor, you know, the sell side doesn't have a clue. How do you know that, you know, Joe Smith is interested in, you know, early stage biotech companies, you know, in a particular area, or certain kinds of products, or so this is, you know, I think what we're seeing now are these really sophisticated data mining technologies that are that are enabling the sell side to go out there and really embrace the retail investor again. So I'm really looking forward to hearing from all the panelists here, and I thought what might be a good idea is each one of you kind of introduce yourselves, talk a little bit about your platform and how it works and how you work with especially with broker dealers. You want to start, Chris?
Sure,
Okay.
I'll start. Hi, my name is Chris Tyrrell. I'm the CEO of Offerboard, which is a platform that owns a broker-dealer, Offerboard Securities, and that does private placement transactions. Our platform uses some patent-pending processes and some dating-style algorithms to actually sift through the data that's available, which thanks to the online sales industry is actually quite significant on the people that are being marketed securities, and tries to match them with investments that they are more interested in, tries to figure out what are they more likely to be interested in. And just like a dating site, when an investor comes in and says that what they really want are 40-year-old white men, but they keep clicking on 30-year-old Hispanics, we're not only watching what they tell us, we're watching what they do, what they're looking at, how long they're looking at it, and we're working on the version, the securities version of people who bought this also bought that, and trying to navigate that regulatory and technological minefield. The broker-dealer that we own has 17 bankers in it, all of whom have particular industry expertise. So we're also doing a lot the old way. I think the earlier speaker who mentioned bank and the issues it had with having to get on the phone, the securities we're selling are securities that are sold, they're not bought. And so I think for a long time there'll still be people getting on the phone and talking with investors. We'll still be organizing the virtual version of a roadshow. People will still want to see the whites of their eyes and talk to the people who are actually involved. So we're operating a platform according to the data that we just finished analyzing, and there's a white paper for everyone outside that I'll talk a little bit more later. We have the third most reported Reg D transactions of platforms operating in the space, and we're going to continue to try to innovate and move forward. Before I let someone else speak, I just want to acknowledge that the person in the world with the most experience actually closing accredited and unaccredited transactions is here with us. Paul Niederer is visiting from Australia, and the Australian Small Scale Offerings Board has closed 300 transactions and $140 million on their platform in Australia. So we're learning not only here in the U.S. but globally, and I think there's a shifting global marketplace for what we're doing. And I think that's going to really change the portfolio of what we're looking at, how much data we have to do it, and who we're talking to.
I'm Gene Massey with MediaShares. MediaShares is primarily a marketing company that helps brokers and issuers market their offering on the internet. We're especially adept at video and video marketing, which is a very powerful tool right now, which gives you an extraordinary footprint on the internet. If you have the desire to do an offering on the internet, you really do need some marketing. You can't just post your offering on a page and expect everybody to wander in. You really have to be astute at reaching a certain particular crowd that would be interested in your offering. We also have a Quick Shares, which is a transactional system that is a piece of software that can allow brokers to easily interface with an issuer's website and allow people to do the transaction very easily. But primarily, most of our focus is on marketing and offering at this point.
Hi, I'm Matthew Henninger. I'm the CEO of CEDI. CEDI stands for this Collaborative Economic Development Initiative. CEDI is a multi-platform system that focuses on investor engagement and investment in emerging growth companies.
I'm Dresner from Dealflow. Hopefully not.
Airflow.
I'll be whatever you want me to be. As I was listening to Chris talk here, it sounds like we might be doing some of the same things in terms of collecting data and algorithmic matchmaking. With one big distinction, Dealflow is not doesn't intend to be a broker-dealer. For a lot of the reasons that we've been really complaining about today, the regulatory environment, the legal framework, and once you register, there's a lot more that you're going to have to worry about. And actually, I should preface with Dealflow is not yet public. This is a project that I've been working on for about 2.5 years. So it's a long time in development. We're very close. And really what you'll see in a few weeks is in part an aggregated data site where we've collected deal data on actively marketed offerings from the spectrum of deals, collecting filings from the SEC and working with deal portals and their APIs, word of mouth, events like this, social media references, just taking all the deals we could find, putting them all into a data ops funnel and dissecting those deals with a view toward keyword tagging and building a recommendation engine sort of at its core. And it's been exciting. I mean, when we started the project, we were collecting on average about 10 deals a day, and now we're collecting close to 100. Our 1.0 product is going to feature only what most people would consider venture type companies, which are private operating companies doing private placements, but eventually we're going to get into all different types of strategies. For me, the thing that's amazing, and maybe I shouldn't editorialize while I'm introducing myself, but I can't help it. What's sort of missing from the discussion so far today is that there's a lot of sort of complaining going on. We're talking about Reg A and what could happen. We're talking about crowdfunding and what could happen. But right now, there is so much happening now in terms of advertised deal offerings. I mean, a year ago, people would think, well, angel list, seed stage deals, early stage companies. And just on the walk over here, I saw that Jawbone was, the huge consumer electronics company is marketing a deal through an email solicitation. So, for me, sort of the white elephant in the room is what's happening with general solicitation and just an increasing use of, I'll call it aggressive marketing tactics. I'm not familiar with all the interstate regulatory rules there, but I mean, there's just so much happening right now that's already changed the deal business, forgetting what could happen with Reg A and forgetting crowdfunding.
Right.
I made a joke to my partner, Mike, a few minutes ago. I texted him, I said, when we have crowdfunding and when we have Reg A, come wake me up. But right now, there's huge business out there in terms of all these deals being marketed.
So
online.
how many 506Cs are you seeing now? And compared to 506Bs and what you're seeing in the market?
The total fluctuates, but it's been anywhere from 6% to 10% in terms of aggregate deal numbers. So we're always looking at deals versus dollars. And so on average, if there's 100 Form D filings in a day, you'll see 5 to 10 are going to be done as 506C, but that doesn't really accurately give you the picture of 506C, because lots of smart companies, as Sam will probably attest to this, there's so little clarity on the filing, the timeliness of filing, that you could go out and you could have a public-facing deal and you could post your deal on Offerboard or Dealflow or your own website, and you'll file 506C later. I mean, there's no. So I think that there are a lot of companies, a lot of private operating companies, and even a lot of funds that have filed. But it doesn't accurately capture the true public marketing activity that's taking place.
The total for the first year was 8.5%, over 1,900 deals.
8.5% 506.
8.5% of the 506 market
Right.
was
Oh,
506C. So his between 6 and 10 that gets you to 8.5.
Right.
And it was $118 billion in offerings, 18 billion of which was funded, which is actually low. Usually when they file, 65% of it's funded, and now you're talking about only 16% of it being funded. And I think that's because you're talking about more incremental deal activity. You're talking about people who are probably filing earlier because they're taking smaller money early, rather than what a lot of people in a 506B do is they wait to get some momentum and then they take a batch of money at once and then they file.
But it's still pretty sizable considering it's a 506C is only 13 months old.
Yes.
I mean, it's still spread pretty quickly.
It's sizable enough. I mean, today we've been marketing some deals before the site launches. We signed another company on today that's doing a 506C, company called Co-Promote. They've done some venture funding, smart guys running the company and investing in the company. And so for me as a trend guy, I look to companies and deals like that and I say, when these guys, these smart guys are going to do an advertised offering, we've got traction. So, and I'm generally not looking at dollars, I'm looking just at deals. In terms of the dollars, the bulk of the filings that you see are investment vehicles. And those guys are filing and they're maybe being advised by counsel, hey, we file, we have the option, but nobody, a couple of funds have pulled the trigger on real general solicitation. Where the action is today are in these, relatively smaller VC-backed companies who maybe, can't get traction doing it through a traditional placement, but it's happening. I mean, the volume is there. It's pretty good.
Yeah, maybe you could start, Steve, with just talking a little bit about all of this. What's happening now is really creating, and I love what you're doing with your algorithms to really reach retail investors in a meaningful way, and how you kind of liken it to the Netflix of finance. Could you talk a little bit about that? Some of the algorithms. What is algorithm matchmaking, deal matchmaking? How you're reaching the retail investors, and even if you can get into maybe even a couple of success stories or.
Well, I could tell you how we hope to do it. I can give you some glimpses at how we have been doing it, but really what will happen. And internally at the company, there are about 40 of us working on this project, and internally we sit there and we have no doubt that this is going to happen. The basic premise that you could use data to find investors, or that deals are like product. And like any product, there's data associated with it. You could use that data to find buyers for the product. It's advertising. So we know it's going to happen. We hope that it's us that makes it happen. But the short version is that there's lots of data out there on deals. There was a statistic in one of the documents, one of the handouts, that there were, I think it was actually underreported here, it's something like 27 or 29,000 Reg D filings between 2009 and 2012. My recollection is it's about 15 to 20 a year. So lots of deal activity, and that's just SEC filings. So you could capture deals, you could tag those deals, you could index the tags related to those deals, and you could set up a data set made up of deals and all these tags over here on this side of the equation. Then on the other side of the equation, there are investors. So you mentioned you like to talk about retail investors. In our world, retail, we don't distinguish or discriminate. You're either an accredited investor because you're an individual accredited, or you're accredited by virtue of the fact that you're affiliated with an institutional investor, or you're unaccredited. That's all we care about. But for investors who participate in these deals, there's also a tremendous amount of data.
Right.
We've got some very impressive statistics. We've got about 10,000 people who've signed up to the service before it will launch, and we've got very impressive statistics on the number of those people, the percentages that we could collect contextual data on, tags, and use those tags to, again, index and make matches. You know, we went to GW at the same time.
Right.
You graduated 92 or 93?
91?
91, okay. So
I'm sorry, 2005.
I graduated in 92. So I'm running a deal. I'm raising money. It's in media. It's in the New York area. You're somebody who knows New York. You've got preferences to invest in the New York metro area. You know media. We know that you graduated from GW around the same time, and therefore, mathematically, there'd be a pretty good probability we may either know each other or may know somebody that connects us to each other. So you could use all those data points to actually draw people to show them certain deals. So it's, you know, I mean, I could talk forever about it, but that's a glimpse.
It's
and
great.
we've been doing it. I mean, we've taken on about 15 clients, and we have been filtering through our opt-ins and through other channels, if someone's going to file a 506C, to use this tagging methodology to identify potential investors in deals. So we could show that it works.
Yep.
I mean, already we have enough data to show efficacy.
Right. And Jean, maybe you could talk a little bit about, I mean, I know, you know, you've done a lot of work in and, you know, you're really the kind of the guru when it comes to DPOs and you know, really an expert just on that side of the market. How do you kind of see this, you know, your platform working, you know, how now these companies that have been maybe crowdfunded, now them using maybe something like your platform as an exit strategy and, you know, getting out there to the public markets now?
Well, if you're going to be marketing your offering, the first thing you should do is call your attorney, because the mistakes that are made, most of the mistakes are made in marketing. There were two guys a few years back that wanted to do an IPO for a movie on the internet, and they went on CNN during the quiet period and said this stock's going to go through the roof. And so the SEC shut them down, and their offering never went forward because of that. I know a publicly traded company. The guy called me asking me some questions about the SEC's all over him because he had posted an offering on his website without filing any documents, without filing any new documents for a 506. So if you make one little mistake in your marketing, it's over for you. So that's the first thing you have to do. The second thing is if you want to market your offering, you either have to already have a crowd. You have to be Elon Musk wanting to do an IPO for a mission to Mars, which I think would be an excellent idea, by the way. Or Sandra Bullock's next movie, or a radio talk show host that's got 5 million listeners every day. One guy, Adam Carolla, got 1.4 million in 30 days. Well, he's got a radio talk show, and he made a really, really, really funny video on his website. He got 1.4 million of donations in 4 days. So if you have access to a crowd, or you have a story, you can crowd finance. If you don't have those things, then you should have quarter-over-quarter growth, and you really have an investment. And you should talk to your retail broker about selling your offering through traditional means. Of course, supplementing it with an online presence, because everybody wants to be able to go see the offering on the internet. What is it? I want to know all about it. And if it's just an investment, it's not a fan-focused thing, it's not a crowd-focused thing, then your broker is going to need to close the offering because it's just a traditional investment. Am I right about that, Bruce? Bruce is somebody we've been working with. So to answer your question, Dara, you have to have either a crowd or a story to crowd finance. Or you have a traditional investment which you can supplement with an online presence.
And Chris, let's jump for
Well,
you.
can I say one
Oh,
other
yeah,
thing?
yeah. go ahead.
If you have those things, one of the things you can do during your, after your filing, after you file your S1, you can do a live internet broadcast. Has to be live under SEC 33-8591. You can do a live internet broadcast to everyone, and you can take interest from everyone in your offering, and that's actually a selling tool before you're effective. Before your S1 is effective, you can actually take interest in the offering and actually sell it. It can't be a recorded broadcast, it has to be live. And it can be taken, you can take interest from anyone, and then you contact them later after your S1 is effective. After your S1 is effective, you can have a YouTube channel. You can go out to the world. You can sell to anybody. You now have, of course, with the state problem, you still have the 50 states
Size,
unless
right.
unless you're a fully covered offering on NASDAQ. But you can actually go out and sell your offering now on the internet. In addition, and that can be a supplement. David was saying that it's not to disintermediate the underwriter, but you can actually do that with an underwritten deal even. They're using that as a tool all the time.
And speaking of underwriters, Chris, maybe you could talk a little bit, because what I found was interesting when we had spoken is how you're using technology to really recreate the old syndicate format.
Sure. So one of the things that traditional broker-dealers want to do is they want to collaborate to distribute offerings, because broker-dealers have access to different investor groups. They have access to particular investors that are interested in particular kinds of deals. And in addition to kind of interbroker-dealer arrangements, you also have interbroker arrangements within the same firm. You'll want people to be able to easily participate with each other, electronically distribute the documents, the deal, take in the investment dollars in a closing process that's organized, and then pay everyone electronically in a documented way to organize the payout and to split up the capital stack of the fees that are generated amongst the syndicate. And so this looks a lot like a traditional syndicate. Someone's got to be running the deal. That's usually the person that found the issuer. And they've got to make a decision as to how much they're going to let people take for helping distribute that deal. And some of it will still get distributed traditionally. I mean, some of it's still going to be people on the phone, but when they direct the person information about the deal, it's going to be through a platform. They're going to go to the platform and find out about the deal, and they're going to get multiple touch points of both electronic marketing and broker marketing to try to close it. So one of the things we're trying to innovate is to divide up the capital stack and to organize the technology around that kind of collaborative broker-dealer activity in a way that hasn't been done before, in a way that people didn't really envision in the private placement marketplace in the way that they're now doing, because they see the value of organizing these things online, distributing them online, making it easier to build a syndicate, so finding people who have investors that might be interested in that deal, distributing the information, getting the commitments, making the kind of distributions and parceling out parts of the deal to people, and then collecting that interest and closing it. And all of those things can be made more efficient. So we're taking the various pieces of that process, and as we make them more efficient in the broker-dealer that we own, we're also making them more efficient for the syndication process. And we've been talking with other platforms in our space that are in the kind of the top 20, top 30 platforms, and saying, look, let's build a syndicate together. Let's link these networks together, because that'll be much more powerful than any one platform trying to bring Dealflow by itself.
Now, are you guys seeing, not only from platforms, but from some of the old school underwriters that maybe are reaching out saying, we want to work with you, we want to use your technology, and kind of using this as sort of, an enhancer?
That's exactly what's going on, and we've built our model internally to look a lot like that kind of sharing with a traditional broker-dealer. And I was at a conference last week with Ryan Fite of Seed Invest, who confirmed that he's having the same phenomenon happen at his shop, that broker dealers are calling and they're saying, I want to engage in this publicly advertised deal making on a platform, but I don't have a platform. I have a broker dealer and I have brokers and I have investors and I have deals, and they want to move that. And so we're also doing those kinds of deals.
And are you mostly seeing, are these smaller broker dealers? Are you even seeing any larger broker dealers?
This is still the lower middle market.
Right.
This is still a particular size of deal and kind of deal that we have not seen really large broker dealers. I mean, by really large, I'm talking about sub 200 bankers. So I don't know what really large is in this room, but none of the large players have yet, other than asking questions and sniffing around, have yet come kind of in a posture to start doing deals. But I think that's coming.
Yeah.
I mean, the data in the white paper shows that the number of investors in deals is up 50%. The number of deals is up 24%, but the amount of money is not yet up. And I think when that changes, when we start to actually see this enervate the capital markets and change the amount of capital that's available, then the bigger players are going to start to show up.
Gene, how about you?
That the internet footprint that you can make with an offering is the key to the success of it if you're concerned about an online offering. If you're concerned about, I was talking to Lou Taubman earlier, and he was saying they just did an offering that was only partially done on the internet, and they still had people calling up on the phone. And my question would be, what did you do to sell it on the internet? Did you have the whole program on the internet? Was everything there, or did it really require you having to talk to a broker to close the deal? He said he got a certain percentage of the things on the internet. Right now, I think most of the deals are regular brokers, and the internet's being used as a transactional system to deliver the documents and to take the payments.
Right.
So everything is still new. My question to Steve is, are you seeing, since you're aggregating data, are you seeing quarter-over-quarter growth in 506 offerings?
No, I think it's 506C offerings.
Yeah.
I think it's been steady, up and down. We've only been tracking this stuff since September 23rd of 2013, so we've got 4 quarters of data. So I don't know if it's a statistically big enough data set to say that there's real growth. It's just been, it's been in that 5 to 10% range. But I do agree with what Gene's saying about, the use of the internet. And my view, actually I should back up and say the thing that we're building, I'm already an old guy. I'm in my mid-40s, and our view is that the people coming up on the street, the 30-year-olds, they default to the internet for everything. They look for stuff on the internet. They research stuff. They even buy stuff. So deals is stuff. It's complicated stuff, and I don't think we're at the buying part on the internet. But in terms of visibility, marketing, advertising, and internet, offering, all that is totally happening already, and you could see where it's going to go over the next few years. So our view is that the internet, these websites, the portals, it's a triggering mechanism to say, hey, I'm over here, I have a deal and it looks like this, are you interested in it? But in terms of transacting, I mean, in Reg D offerings, complex securities, I don't know if Lou is still here. I don't know what he told you, but I guarantee they're closing all those investments on the telephone or in person. Nobody's comfortable with these deal rooms yet, and there's lots of cool technology there, but I've talked to these people, and I know the investors.
Let me comment on that, and you're right, except if it's like something on Crowdfunder where it's focused on a musician or something like that.
Neil Young might be an anomaly. I mean, you got Eddie Vedder behind you claiming this is the greatest thing to music. And look, there's always going to be outliers. But
that's the only way it's working right now that I can see.
If you look, there's always a way to impulse a guy to put in $10 on WeFund or through some equity campaign where you're going to have great distribution because it's got consumer appeal for sure. But everybody knows the expression.
everyone you know has a deal, and most of them stink. The challenge is to figure out how do you sell the deals that stink, and you could figure that out if you use a lot of data. So increasingly, as people, in your parlance with the crowd finances, they come to the internet and they sign up to these portals. You'll have visibility. Who are these people? Are they institutions? Are they retail? Are they high net worth? And if you're able to collect all that data, you can make sense of it, and I think show them, the products that also stink, and there's a buyer for everything. Who said that? P.T. Barnum, I think. Something like
There's
that.
one other issue. If you're using,
That's not what I meant. That's not what I meant.
I know that
one other issue, Dara, and
Yeah.
that's if you, the nice thing about the internet is you can aggregate tiny investments. A broker is not going to want to sell $10 worth of stock, but you can sell $10 or $100 worth of stock on the internet. So you can fractionalize the investments into tiny increments. And then you build a crowd that you have their data, you have their information on a suitability. On the S-1 form, when they buy share stock, you know how much they make. You've got their payment information if they bought it through an ACH checking account. That's very valuable data. So if you could theoretically have 1 million shareholders that all put in $50. Now, why would you want to do that? Well, you've got 1 million people that you've got all that data on. You've built a crowd of people, and you have their payment information.
So, Andy.
I have 3 questions. I came a little late, and they're so basic. David probably knows the answer to all of them. Number one, how do you get around the know your customer? Do you need an IPO? I mean, we can't sell IPOs in my firm to new accounts.
I can answer.
And you need capital.
And you need capital to do the offering, is that what you're saying?
Yeah.
You absolutely do. And that's why there have been, we have an issued U.S. patent to finance movies with an IPO. And there haven't been any because it costs $300,000-$400,000.
Well, and if you remember,
But to answer your question about the suitability,
1 and 2, you'll know why.
about the KYC, about the KYC, it's the same thing as a broker. You essentially, we're working with Folio, okay? There's no secret. We're working with Folio. We put a page on an issuer's website, and they're really filling out the brokerage form for Folio. It even says you're now opening a Folio account. But it's a page on the issuer's website, and we drive the traffic to that page. That's what we basically do. We drive the traffic to the purchase page.
The issuer knows the customer, but does the underwriter know the customer?
Absolutely. Why not?
Okay.
Because they're
How
opening
does
a
the
brokerage
underwriter
account.
verify it?
Well, it's just like you open an account on E-Trade. You can
I
open.
don't know, I've never done that,
Okay,
so
well
I don't know.
if you open an account with Schwab, which requires $1,000 up front, look at my blog. It's a joke. You got to put $1,000 in before you buy anything. If you went on Amazon and you had to put in $1,000 before you bought anything, you tell them, hey, why do I have to do that with stock? I just want a few shares. So you go in, and that's what Folio does. We can open an account for a penny. Open an account. They want the account. They want that data. They want that demographic information. So it's just like opening an E-Trade account or a Schwab account. You've got the same know your customer suitability information. It's regular. You're opening a brokerage account when you buy a share of stock, except you don't have to put in the $1,000 up front. You don't have to pay $20 for the transaction, and you don't have to buy 100 shares. That's the difference. That's what makes crowd financing possible.
Okay. So, and so does that give one who has an account prima facie the ability to buy a hot
Yes.
that movie?
Yes, and here's what it does. You've got they open an account,
No.
huh?
No, it doesn't. You still have to do an independent suitability analysis.
Right.
That's why I can't sell somebody $10 worth
Right.
of stock, because I
Right.
can't afford to do a suitability analysis on
Right.
1 million investors for $10 a pop.
Right.
It's a little more than that. Well, like Lou,
It's a little more than
It's a lot more than that.
well,
And you can't automate the entire suitability. I can automate AML, I can automate KYC and FinCEN and the Google search that I do on everybody, and store all that data. But I
Right.
can't automate the suitability. I'm going to have humans making a
Right.
judgment call every time. Now they're going to do it based on a lot of automatically gathered data.
Huge aftermarket suits, particularly with respect to stability.
There's going to be they're going to happen.
I would disagree with you. Folio's doing it now.
Okay.
And you can open an account for a penny.
Great. So, and with respect to the capital requirements to do this, how does that work? If you're an underwriter, aren't you?
You're not really
Well,
underwriting.
you don't have an underwriter. You're doing a best effort offering. You have a sponsoring broker,
Okay.
okay, to assure compliance in all areas. Are you with me? You got a sponsoring broker.
Yes, I am.
Okay, to assure compliance in all areas. And basically, it's a best effort,
Okay. It sounds like lip service.
okay?
You can do it with a nickel BD.
Okay.
You don't need, if you're not holding customer accounts, if you're doing it all with bank escrow,
Okay.
if you're doing it all using, the standard procedures that any nickel BD has to go through in a raise of that kind for escrow process, you're not holding any money, then you can do it with a nickel BD. But there are a lot of people who are doing a lot of deals platform to BD, and they're machinating the money to try to get the money out of a BD into an entity that's not registered with FINRA and the SEC, and the hammer's going to fall. The hammer is going to fall, and what most of the platforms that are now getting traction are doing is they're forming a nickel BD. That nickel BD does nothing but have an interbroker dealer agreement with a lead BD,
Right.
and that's what most of those deals look like.
It's for 506 mostly, though.
For 506 offerings. This isn't for public offerings. So there's some
Off-balance sheet financing.
and yes, and those balance sheets are going to be lit on fire by somebody at some point, and it's going to it's going to change them. It's just going to change the market model for everyone, and everyone's going to realize you have to be a BD, at least in the Title II business. Everybody's got to own a BD, and they've got to do it right, and they've got to do it more expensively because of all those other things we mentioned.
Preempts a $10.
And it's just never going to get to
Purchase
$10
price.
in the Title II world.
I'm exaggerating with the $10. I
It's-
agree with you.
I don't
It
think
ain't
it's ever
gonna
going
be
to get to
$10.
five. It might get to $5,000 or
Right.
$2,500,
Okay.
but that's
Well,
that's
No,
kind of
that's,
Well,
we're
Lou's
gonna
Lou's doing
bring
350
Dave
now.
up because we're kind of, we need to get moving on time. So, but this was great. They're gonna be around at the cocktails after.
We're gonna go
so-
out back and fight it out.
And